Of course, as an entrepreneur, we're happy to pay taxes. But we shouldn't pay more than what we need.
Yeah, we could look at dropping it from 25 million to potentially between 12 and 15 million.
Welcome to another Dan Lok Advisors series. Now, this particular video is something that I've been thinking a little bit, and that is why succession planning is essential for any entrepreneur. Maybe you are building a business to a stage where you want to exit. What does that look like? Or maybe you want someone to take over. What does that look like? What are some of the kind of the tax consequences that we have to be aware of, right? So, Kyle, welcome back.
Thank you.
Talk to us about why succession planning, and how does it work and why is it essential?
Well, actually, when we're looking at succession planning, there are a few different types of succession planning that we should look at. One is planned, and the other one is unplanned.
Okay.
So,
planned and unplanned.
Yeah, so we might want to start with the unplanned first. It's a little simpler, and of course, unplanned is something that we're not really going to expect and maybe not be ready for. So basically, when we look at an unplanned succession, we're looking at 5 Ds.
5 Ds.
Yeah, 5 Ds. Death, disability, disaster, divorce, or disagreement.
Okay.
So for at least 3 of those things, we can get insurance. We can get insurance for disability, death, or disaster. So those 2 things are covered. But essentially what we need to do, again, we talked about a shareholders agreement before. We're gonna want a shareholders agreement in place so that everybody understands what is going to happen in the business if any of these events happen.
When you say disagreement, is it disagreement between who?
Between the partners of the business.
Got it. The shareholders.
Exactly,
Got
the
it.
shareholders.
Got it. Okay. And divorce, of course, you can. Wouldn't it be nice you can get insurance for divorce?
Yeah, I know. I
That
was
would be
thinking
great.
that would be a good idea.
That would be a good idea. So the 5 Ds, so that's unplanned.
Yes.
What does plan looks like?
So a planned succession is when you either start to pass it down to your next generation, or you get the business ready for sale to somebody else.
Okay.
So I've got a bit of a story that I can give you for an unplanned succession.
Yes, please.
And how that might go well. So we have Erica, and she's a 50-50 partner in a successful renovations company. So Erica's husband is crazy. So nobody would ever want to be in business with Erica's husband.
Got it.
So Erica and her partner Joan, they get together and they have a shareholders agreement. And in the shareholders agreement, they say if one of the partners is to die, and especially Erica with her crazy husband, the other person in the business would buy those shares from the family.
Got it.
So that way Joan knows that she will never be in business with Greg.
Yeah. Which is the crazy husband.
Yeah, exactly.
Got it.
And Erica knows that her family's going to be okay if she passes away.
Okay, so if either one, death happens, the other partner would buy the shares.
Exactly.
Got it. Okay.
And something like that would probably be funded with an insurance plan because basically we need that liquidity at that time.
So walk me through that a bit, just for my viewers. How does the policy fund that particular?
So what would happen is Erica would die.
Okay.
And at that time, the shareholders agreement would now kick in.
Yeah.
So Joan would need to buy the shares from Erica's family.
Yes.
So Joan would consider, okay, where am I going to get that money from?
Yes.
All that money from the life insurance plan comes into the company.
Okay.
And now Joan uses the money that comes from the insurance plan to pay out Erica's family.
So for Erica passed away, the insurance company pays big lump sum. Jones could use that to buy the shares, because Jones or the company may not have enough cash at the moment.
Exactly.
To buy out the shares. Then would Jones then pay off, I guess, Erica's side, the husband, long term? How would that work? Because it is still Erica's money. It's her life insurance policy, right?
It's her life insurance
Goes to the
policy, but it
company.
was actually owned by the company.
Got it.
Yeah.
Got
So
it.
the company got the benefit.
So
from the
during that
policy.
time, the company is paying for the
Exactly.
monthly payment.
Exactly.
Makes sense. So then it's also a kind of like a insurance policy for Jones.
It is. Yeah. It's an insurance policy. Really, the insurance policy exists for the business.
I love
because we want the business to
keep
be
going.
able to continue, right?
To keep going. Okay, that makes
Exactly.
sense. That makes sense.
So an interesting thing about this too is because it is insurance, it will create a capital dividend.
Okay.
So that money will come out of the corporation tax-free as well.
Got it. Which is huge.
Yeah.
It's huge.
Yeah, it could be a lot of money.
What are some of the other vehicles that we should be aware of?
Well, if we're looking now at a planned exit, there are a few different vehicles. Number one is an estate freeze.
Okay.
So if I'm thinking that I want to pass my business down to one of my kids, what I might consider is freezing the value of that business today,
Today, yeah.
taking some voting preferred shares, and then giving all the common shares to my kids.
Got it.
So I can do that so that, for example, the tax that I have to pay is only on the shares valued on the business today. And what I can do is I can get my kids to start paying out those shares over the next 30 years. So really what I've done is I've whittled my tax liability down to nothing.
Versus
on the
you
company.
have a huge, massive tax bill.
Yeah, otherwise
right?
when I die, my tax bill could be astronomical.
And that, in some cases, could destroy the business.
It could. It
Right.
could. Because if the business doesn't have the liquidity to pay the tax,
And most businesses probably don't.
exactly. they
Even
may
if you're
have-
doing well, most businesses don't have a ton of cash sitting around, right?
Exactly.
Yeah, that makes sense.
So the business may end up going up bankrupt as a result.
well,
of
that
that.
would be sad. What are some
Yeah.
of the other vehicles or tools that we could use?
Well, if we look at another kind of planned exit, we might actually want to sell our business to somebody else.
Okay.
So there are a few things that we can take advantage of in that case. For example, we'll just take a quick example of Ed, who's an entrepreneur. So he's been a tech entrepreneur and built a business from $500,000 up to $100 million.
So it's worth $100 million now.
Exactly.
Okay, 100 million valuation. Yeah.
So if he were to just pay the tax on that business when he sold it,
Yes.
that would be $25 million that he would have to pay on that, right?
That's a lot of money.
Yeah, it's a lot of money.
Yeah.
So there are some things that we can put in place to make sure that he doesn't have to pay as much tax when he's doing that transition.
Can you walk me through
So-
how would that work?
Yeah, so what we would do, number one, it's not a huge savings, but one that we'd look at is the lifetime capital gains exemption.
Okay.
So that means that on over $800,000 of the business, we wouldn't have to pay any tax on that money.
Okay, yeah. That's in Canada. We're talking about Canadian, right?
Yeah. And we can still do an estate freeze in this case.
Yes.
So
Yes.
we would freeze the value of some of those shares.
Okay.
We would use intercorporate dividends.
Okay.
So what we would make sure that there's a holding company that held some of the value of that business, and we would take the assets out of the business using intercorporate dividends, which are dividends that are not taxed.
Okay.
And then put all that money into our
Okay, so
holding.
some of that we could use that. Okay, to pay a little bit less.
Exactly.
Okay.
And then there are some things that we can do. Not necessarily sure whether everybody needs to, but something like flow-through shares. There are some personal tax deductions that we can take to help manage the risk. Charitable donations.
So Carl, what would be the difference? Let's say Ed selling the company for $100 million, with no planning, he'll pay $25 million just like that. With some planning, how much Ed could save? Same exit, like just rough numbers.
Yeah, we could look at dropping it from 25 million to potentially between 12 and 15 million.
That's almost a $10 million in savings.
Yeah.
Just that's That's crazy. That's insane.
Yeah, again, with something like that, it's fairly complex. You'd probably want a few different professionals involved.
Yes.
But we can reduce the tax
And for
quite a bit.
Ed, when should he talk to those professionals? Would he talk to professionals probably way before he's thinking about selling?
Actually, really what you want to do is 2 years before the sale.
Yes.
You want to start putting these kind of things in place.
Yes, to minimize the tax.
Exactly.
Otherwise, the government sends you a happy thank you card.
Yeah.
Of course, as an entrepreneur, we are happy to pay taxes. But we shouldn't pay more than what we need.
No.
Right? We need to be smart. We work hard for that money. We'll pay for, the law tells us what the government is entitled to. But if we're smart, we're taking advantage of some of these vehicles, all these legal vehicles, black and white, that we still pay the 10, 12 million, still a lot of money.
Yeah.
But just not the 25, right?
And actually, when you look at what our actual responsibility is in terms of tax, it's our responsibility to determine our own tax.
Yes.
So
Yes.
We wouldn't choose the highest tax rate possible for ourselves.
So succession planning is for someone to kind of pass the business down, or for someone who's thinking about exiting.
Exactly.
Yeah, so it's not just like death. It's not always just talking about if you pass away, but if you think about exiting, there are different vehicles that you could take advantage of. But if you don't know, if you don't hear some of these discussions, some of these tools that are available, and sometimes your accountant may not be able to tell you that.
Yeah.
Right?
Not every accountant is an expert at succession planning.
Yeah, so it's a whole different. It's a specialized skill on its own, right? Awesome. Yeah, that's super helpful. Comment below if you have any other questions, and don't forget to hit the subscribe button and turn on the notification. We'll see you next time in the Dan Lok Advisors series.